Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome back to the Deep Dive. You supply the stack of sources, and we are here to, cut right through the market noise and find the genuine signals.
Exactly.
Today, we are deep diving into the cryptocurrency landscape, which, right now it's presenting this profound paradox. You have these flat, almost fearful prices existing right alongside massive, undeniable institutional adoption and technical maturity.
That's precisely our mission today. We're taking the latest market data, these security incidents, and the regulatory announcements to really identify where the real confidence lies.
Right.
We need to look past the daily volatility charts and focus on what's being built, what rules are being enforced, and frankly, how sophisticated infrastructure is moving capital in ways the average investor just isn't seeing yet.
We have a lot to cover. We're going to start with the contradictory data that defines the current market sentiment. Why is the price stuck even as inflation eases?
And we'll get into that major security breach.
Yeah, the $7 million breach that hit Trust Wallet, and we'll discuss the immutable rule it really reinforced. Next, we'll look at Russia's landmark move in crypto lending before shifting to ecosystem health.
So we're talking a major token burn, what that means for supply, and why mining efficiency is suddenly a $1 trillion business.
Exactly. And we'll finish up with a focus on the UAE, where powerful AI innovation contrasts sharply with a piece of, movie plot crypto crime.
Okay.
Let's unpack this. So let's start with the big tension. Macroeconomic indicators have been improving. We've had reports of decreasing inflation.
Right.
And the federal chair, Jerome Powell, is hinting at potential interest rate reductions. Historically, this kind of environment, it acts like a strong tailwind for risk assets like Bitcoin.
It should, yeah.
Yet the global crypto market cap is just stuck right around $3.05 trillion. Prices are flat, and that widely cited market sentiment index is stalled at fear. a score of 29.
Hmm.
Why isn't the positive macro news translating into momentum?
Well, that fear score is, it's entirely justified if you look at how traditional capital is actually moving.
Okay.
The immediate bearish signal is this significant capital drain from the major investment vehicles. We are seeing massive ETF outflows.
Massive.
Yeah, totaling $314.6 million in just the last few days. That $250 million exiting the system is a concrete, quantifiable expression of current investor sentiment. People are pulling money off the table.
That is a staggering vote of no confidence from institutional ETF holders.
It is. And that outflow is compounded by low trading volumes overall. We saw Bitcoin's 24-hour volume sitting at a relatively meager 15.06 billion over the recent weekend.
So you need more than that to get things moving.
Oh, much more. To initiate a true bull run, you need sustained increases across stablecoin volume, 24-hour trading volume, and critically, those ETF inflows. Right now, 2 of those 3 are pointing strongly downward.
But okay, here's where we find the signal amidst the noise, and this is the data point that runs counter to everything else you just mentioned.
Right.
There is one metric on a significant, sustained uptrend: digital asset fresh inflows.
This is the data that forces us to look beyond the retail price chart. While speculative capital is leaving, fresh capital inflows are holding strong at $3.83 billion.
Wow.
And that's why the total value locked, or TVL, remains surprisingly consistent at about $118 billion. But the key insight here is not the number, it's the destination. This inflow is overwhelmingly connected to proof-of-stake protocols.
So if these billions are flowing in, but the price isn't really rising, how does that work? What's the economic driver for these buyers?
It means we're seeing sophisticated business adoption, not speculative retail trading. You see, when a business or a large institution buys proof-of-stake assets, they often aren't doing it to flip the coin next week.
They're in it for the long haul.
Exactly. They are buying them to put them immediately onto their balance sheets and become a network validator. They're staking the assets.
So instead of betting on price appreciation, they're locking the assets up for a guaranteed network yield and securing a long-term position in the ecosystem.
Precisely. This allows them to generate predictable, safe yield that can be factored into their internal accounting, and it demonstrates a long-term stake in the network's success. It suggests underlying business confidence is really accelerating, even while the average retail investor is paralyzed by fear.
Okay, shifting gears a bit abruptly, let's talk about some of that negative news. The reminder that convenience often comes at a pretty steep cost.
The Grinch moment.
Yeah. Users of Trust Wallet collectively lost approximately $7 million, and it was traced back to a vulnerability in their Chrome browser extension, specifically version 2.68.
It was a serious insert and was quickly flagged by the on-chain researcher Zach XBT. The immediate advice for anyone using that specific version is, disable 2.68 immediately and update to 2.69.
A simple update.
A simple but critical update. This incident really highlights the hidden threat surface that even something as convenient as a browser extension can introduce into your security model.
The silver lining here, which I think speaks volumes about the deep pockets backing this operation, is the promise of full user reimbursement.
That's the critical institutional safety net. Trust Wallet is backed by Binance, and former CEO Changpeng Zhao, or CZ, he confirmed publicly that all affected users will be made whole.
Right.
This is a continuation of Binance's long-standing policy, often encapsulated as funds are safe-oo or safe, and it provides a significant centralized relief valve for those who were affected.
But the irony here is it's profound. Trust Wallet is a non-custodial wallet. It's designed to give users sovereignty over their funds. Yet the point of failure was centralized, a reliance on a single vulnerable piece of third-party software, the browser extension. This incident, even with the reimbursement, it just circles us right back to that core philosophical motto of the crypto OGs.
Not your keys, not your cryptocurrency. You're spot on. We often think of centralized risk purely in terms of an exchange holding the keys. But this demonstrates that relying on any third-party interface, even one meant to access your own keys, introduces an external layer of vulnerability that can be exploited.
So true security is more than just owning the keys.
It's about owning the physical storage and minimizing reliance on those centralized access points. Because once the key is compromised, no amount of reimbursement changes the fact that the immutable network rules were used against you.
That discussion about institutional security, it just sets the stage perfectly for our next segment because banks, especially giant national banks, they only move when they feel secure.
Absolutely.
So let's transition to a massive positive signal on the institutional front, and this is coming from Russia. Sberbank, that's SBER, the country's largest financial institution, has issued Russia's first ever loan using cryptocurrency as collateral.
This is a landmark event. I mean, you're seeing crypto move from just a speculative asset to a leveraged financial instrument within the traditional banking system.
And the pilot loan went to a miner.
Right, to Intellian Data Systems, a major local Bitcoin mining firm. It really demonstrates how the system is being designed to support the underlying infrastructure.
And the mechanism Sberbank used is what truly makes this different. It wasn't just a verbal agreement. They used proprietary hardware called root broken. What exactly is that, and why is it the key to the bank's confidence?
So, Root Broken is a specialized hardware solution designed specifically for institutional custody management. In essence, it acts as a highly secure, segregated vault for the digital collateral.
Okay.
When Intellian secured the loan, they transferred the collateral, into this secure environment managed by Sberbank.
So the bank is using this specialized hardware to ensure that if the borrower defaults, they can instantly and immutably access the collateral
Precisely.
without needing to navigate complex legal hurdles or face volatility risks during some long sales process.
That's it. It mitigates the two biggest fears a traditional bank has when accepting volatile collateral: counterparty risk and volatility risk. The hardware ensures the assets are held securely, and their release is governed by a preset smart contract trigger.
It's a huge deal for these companies.
It is. This move effectively allows Russian companies to leverage their existing digital treasury for operational funding without selling their assets. It's a major step.
And this isn't happening in a vacuum. The sources indicate the Bank of Russia is actively working on a specific regulatory framework to streamline and simplify crypto adoption. This isn't just one bank acting rogue.
No, this is government-sanctioned financial innovation.
Now, let's connect that security focus back to the basic infrastructure of Bitcoin itself, mining. We have two key developments that speak to the long-term health of the entire ecosystem. First up, infrastructure professionalization. Interash acquired a controlling stake in Neopool.
This acquisition, which was confirmed at the Bitcoin Miner Conference in Abu Dhabi, it really highlights this relentless pursuit of efficiency. Neopool is currently ranked #1 in daily payout efficiency. Interash sees mining pools as an, I quote, undervalued part of the Bitcoin ecosystem. And their strategy is clear: improve efficiency for all miners, regardless of their size.
So for the listener who might not be running a rack of miners at home, why does daily payout efficiency matter so much?
It's crucial for business viability. Mining profitability is highly variable, right? So efficiency refers to two things. First, how quickly the pool finds a block, and second, how reliably and consistently they distribute the rewards.
Predictability.
It's all about predictable revenue streams. Being #1 means Neopool offers the most predictable stream. And as mining difficulty continues to climb, and based on the adjustment schedule, it's expected to reach a new all-time high in early January 2026. Only the most efficient operations will survive.
So it's consolidation.
Consolidation and professionalization, yes. It's necessary for the network to remain secure and robust.
Okay, shifting from the infrastructure backend to the token health front. Uniswap Labs, a leading decentralized exchange, implemented a major deflationary move.
A huge one.
They decided to burn approximately $600 million worth of UNI tokens. That's about 100 million tokens.
This is a classic tokenomics play. It's based on the fundamental principle of supply and demand. They executed this massive burn by rolling out a new fee system.
Okay, how does that work?
Well, it now directs some transaction fees to be burned, rather than having all the fees go exclusively to liquidity providers. This applies across their V2 and V3 pools.
That seems like a massive shift in incentives. If fees are being burned instead of always rewarding the LPs who secure the platform, I mean, how do they justify that?
It was a significant governance decision, no doubt, but it's aiming for long-term scarcity and value retention over immediate rewards for liquidity providers.
So a trade-off.
A calculated trade-off. LPs still get the bulk of the fees, but the new mechanism introduces a continuous deflationary pressure on the UNI token supply. By reducing the supply, they increase scarcity, which is intended to push up its long-term token price, benefiting all the existing holders. Exactly. It's a move to prioritize scarcity and overall ecosystem health.
Let's pivot now to the Middle East, specifically the UAE, which just continues to be this magnet for both high-tech innovation and, well, high-stakes criminal activity.
A fascinating duality, yeah.
On one hand, you have Abu Dhabi implementing some really powerful positive AI. The Environmental Agency of Abu Dhabi is deploying AI and satellite tech to identify illegal waste dumping sites in the Al Ain region.
And the results just speak volumes about the power of applying AI to real-world physical problems. The AI system achieved over 90% accuracy in detecting these sites.
That's impressive.
What's really critical for the public sector is the efficiency gain. The AI identified 150 waste sites, which is dramatically more than the 43 found by traditional field teams on the ground.
Wow.
The system remotely monitors land, tracks how long the waste has been there, and even classifies the waste types, making enforcement immediate and targeted.
That's a powerful, scalable use case for governance.
Mhm.
But then we have the human element,
Mhm.
which proves that no matter how advanced the technology, basic human greed still finds a way. We have a genuinely cinematic cautionary tale out of Dubai involving a fake crypto deal that defrauded an investor of $1 million in digital assets.
This was a meticulous fraud scheme. A Dubai court ordered a woman to pay 4.3 million dirhams. That's the equivalent of the stolen $1 million.
And she didn't act alone.
No, she collaborated with her fugitive husband, who falsely claimed to own a reputable investment company. They arranged a meeting with the investor under the pretense of verifying finances.
And this is where the movie plot kicks in. What was the actual mechanism of the theft?
So during this private meeting, the woman created a distraction. While the investor was momentarily preoccupied, she executed a literal switcheroo, secretly swapping a box that contained the device that accessed the crypto wallet.
Oh, way.
Yeah. The moment the physical device was swapped, the assets, $1 million in digital currency, were immediately transferred to accounts held by other parties.
That required synchronized, real-time coordination to move the assets the instant the device was switched.
Absolutely. The outcome provides a sobering end to the story. The woman was jailed for 2 months, heavily fined, ordered to pay the penalty to the victim, and then deported.
A strong message.
A very strong message. It shows that while countries like the UAE are pioneering regulatory frameworks, they're also dealing head-on with these highly organized scams that rely more on distraction and sleight of hand than on complex code.
So let's tie these contrasting threads together: the institutional security, the market fear, and the regulatory advances. The central listener question we can address through all this is, will crypto-backed loans, like the one Sberbank executed, become common in other countries?
I believe this trend is absolutely foundational. It's inevitable for the future of finance. The core mechanism is just so elegant. You use high-value crypto, like Bitcoin or Ethereum, as collateral.
And you get fiat currency for your business needs without having to sell your asset.
Exactly. The lender, like Sberbank, uses secure mechanisms, proprietary hardware or smart contracts, to safely hold the collateral. Once you repay the loan, the crypto is released back to you.
So what are the primary global forces driving other banks and fintechs toward this model?
I think we're seeing 3 major drivers. First, just a growing global crypto adoption means there's this massive pool of assets held by businesses who want to leverage that wealth. Second, there is intense pressure on banks and fintechs to innovate their lending products. And third, institutional interest. Large fund managers want safe, predictable ways to enter the crypto ecosystem as facilitators, not just as speculative buyers. The loan mechanism is a safe on-ramp.
But based on the complexity of that root-broken system Sberbank used and the prevalence of scams like the one in Dubai, the biggest challenge has to be regulatory clarity and security standardization, right?
That's the key. The prevalence of these loans depends entirely on jurisdiction. Governments are still highly cautious due to volatility and ongoing criminal activity. But in countries where regulators are moving quickly and decisively, notably the UAE with its regulatory clarity and parts of the US, we are seeing an acceleration of this innovation.
So the better the custody, the faster the adoption.
The more secure and standardized the institutional custody solutions become, the faster these crypto-backed loans will become a standard, almost boring option for corporate funding. So to summarize this entire deep dive, we started with the market paradox. The market sentiment is stuck at fear, reflected by flat prices and those massive ETF outflows.
Right.
Yet, that fear doesn't capture the full picture. Simultaneously, we're seeing deep, sophisticated institutional infrastructure being laid. The secure Sberbank loan, the consolidation of mining pools, and massive token health measures like the Uniswap burn.
Mm-hmm.
This confirms that adoption is accelerating fiercely at the core business and institutional level, even if the general retail price action is slow and fearful.
That really redefines how we measure the health of this ecosystem.
Huh.
The market sentiment is fear, but the single largest institutional transaction we discussed was Sberbank securing a corporate loan with crypto, only possible because they used a highly specialized hardware solution called Rootbroken to manage the risk. Does the sophisticated security surrounding that loan suggest that the key to mainstream institutional acceptance isn't just price action or regulatory approval, but the creation of highly secure, centralized institutional custody mechanisms that can manage and mitigate risk for decentralized assets? Something for you to mull over as you watch the next price chart. Thank you for supplying the sources for this deep dive. We'll catch you next time.